Good morning, everyone, and thank you for joining us for this webinar this morning. My name is Raphael Edmeyonu, and I'll be your host. We thank you for taking our time from your busy schedule to join us this morning for this webinar, and we hope that we will be able to make the best use of this time that you're dedicating to us. It's been observed that, since the global recession in 2008, a couple of people have stayed away from the capital markets, while a couple of other people have actually, decided to stay on. And from the numbers that we have seen, it looks like they have made significant advantage of that opportunity. They've taken significant advantage of that opportunity. Especially with the numbers that we saw in years like 2013, when the Nigerian Stock Exchange returned in excess of 40%. And then in 2020, when it made the headlines in the global news as the best stock exchange return in the world with over 50%. These are part of the things that our presenters will also be speaking to us about today. If those opportunities are still there, if we need to continue, if we should also, if we haven't been leveraging on those opportunities, and these are things that, we need to begin to look into and begin to tap into. I think our two presenters will be able to provide more insights as to the direction that we need to take, especially for our long-term investment portfolio. Without any further delay, I'll quickly mention that the rules of the webinar is that as the questions cross your mind, please drop them in the Q&A box. We will do our best to respond to those questions at the end of the presentations. And for questions that we are unable to cover, perhaps we might be pressed for time, we would share a more detailed question and answer document in a few days to everyone that has registered with their email addresses. So going straight into it, our Managing Director, Mrs. Kai Oga, would welcome us with the opening remarks. Kai joined ARM in 2013. She has a robust experience in the financial sector space, ranging from banks to asset management. She schooled in Abu Zaria, and she got her master's from Manchester University in the UK. Kai is she's completed an advanced management program in INSEAD. Please join me in welcoming Mrs. Kai Oga for the opening remarks.
Thank you, Raphael. Good morning. Good morning to our distinguished guests and esteemed participants. I welcome you to our webinar. We titled it Equities, the Superior Long-Term Investment. So it's a great pleasure that as we kickstart today's discussion, I'm privileged to extend a warm welcome to each of you for joining from everywhere within the country and even around the globe. Thank you so much for joining. Today is very important to us as it marks a moment for us to come together and delve into the fundamentals and strategies of investing in equities. I mean, we've seen that our economic environment is ever evolving, and the opportunity for expansion and building wealth through equity investments remains resolute. So our aim today is not only to share valuable insights, but to catalyze meaningful dialogue and foster actionable solutions that would help you, empower you to make informed investment decisions. So throughout the webinar, we'll find that our expert panel will carefully examine the latest market trends. They'll be offering you valuable insights to keep you ahead of the curve. We'll also explore which sectors are expected to experience growth, which ones will be, which effective strategies would there be for identifying high-performing stocks, and then look at ways to mitigate risk through diversification and long-term investment approaches. And overall, in addition to this, we would also set aside time for question and answers, where you would have the opportunity to engage directly with our panelists, and of course, we get your questions answered. Overall, the webinar has been designed to provide you with practical knowledge that would help you maximize returns on your investment and help you to navigate all of the complexities of the equity market. So I'm very, very excited about the opportunity that we can both learn and grow together as we explore the superior benefits of long-term investments in equities. I won't take too much of your time with my welcome speech, but let's go right into it and I'm sure this will be an enriching experience together. Thank you so much for being here. We don't take it for granted. And thank you for your continued trust in us as we journey toward a prosperous future. So I'll hand over to Raphael to take the conversation from here. Thank you so much once more.
Thank you, Kai, and thank you, clients, for joining us once again. We just can't thank you enough. Mrs. Kyoga said thank you so many times. In fact, I lost count of the number of times that she thanked everyone. And I think that's just to show that, we value you a whole lot, and we're not taking this moment for granted. So going straight into it, we will take a poll, which will usher us into the first part of the presentation, just before I introduce the first presenter of the day. Please look onto your screen. We will be launching the first poll at this time. All right, so the first question should be on your screen right now. Which investment do you think is suitable for long-term wealth accumulation and growth? First option you have there is equities, second one is fixed income, and the third is real estate. Kindly select your answers and submit. We will be doing this just for a few seconds, I think about 10, 20 seconds, and we will close the poll and see the results of what we're thinking in terms of our long-term wealth accumulation and growth strategies. Keep it coming, keep it coming. Please look on your screen. You will see the question of our first poll. Keep it coming, keep it coming. All right. Whoa. 12% of everybody on the call right now believes that fixed income will take them there. 32%. Oh, people are changing their mind right now. Okay. People are changing their mind. Fixed income, 14%, real estate, 32%, equities, 52%. That's the results we have right now. And I believe that our first presenter will provide more insights as to how these decisions can be better off. So introducing our first presenter, Alieza Joe Madugu, a senior portfolio manager in ARM with vast experience in the equity space. He's held senior roles as head of equities and alternative investments and head of research as well at two Nigeria's largest pension fund administrators before transitioning to the asset management space. Alieza graduated from cum laude from the American University of Nigeria with a bachelor's degree in economics and a minor in international comparative politics. Please join me as we welcome Alieza Joe Madugu.
Thank you, Raphael, for the introduction. Very much appreciated. So to start the presentation, I'll be setting the scene, by letting us know some key things we consider while we're making investment decisions. So first of all, we're in a challenging environment. We're in the frontier markets. That's where there are policies, there are a lot of policy uncertainty, flip-flops here and there. As investors, people in this environment, we are always trying to decipher what to do, what to make of these policies, how do it impact me, how do it impact my investments, how do it impact companies and stuff like that. So what we are doing here is to just let you know when we receive those informations, what do we do, and give you tips on how to do that yourself. So first, to make an investment, you need to do your due diligence. So we have three things we've outlined in this presentation on how we do this. This macro news comes out. We see GDP information coming out, budget deficits. We hear CBN is increasing rates. We hear they're trying to reduce FX backlogs. What does that mean for me? What does that mean for my investment? How do I make sense of that? So the next step is to now see my portfolio, which of my portfolios are reacting to these policies? How can I restructure my portfolio in a way to achieve strong returns, no matter where we are in the economic cycles or no matter the kind of government policies that are introduced. You want to have a resilient portfolio that can generate returns that help you achieve your financial goals. And so to do that, we'll just take us through some of the most recent policy announcements we've had in the past year that we believe are significant and how they've impacted markets. And so you can see what we're talking about. The first one is last year we saw in May there was a removal of fuel subsidy as soon as the new administration came. That was a big development, and it led to gains in the oil and gas sector. We saw significant gains because deregulation meant improved profits for those companies. But in the larger market, we also saw gains. In the financial sector, when they liberalized the exchange rate market, this is a policy that a lot of investors have been asking for. We also saw significant gains in that sector because they have dollars on their balance sheets. When you announce a devaluation, what do you get? You get gains from those devaluations. So that was a big thing. But furthermore, the entire market benefited. Why? Because we see foreign investors coming back to the market. In the second half of the year, that's from June to December, we saw FPI increase 21% year on year because of these kind of policies. Other policies that happened during the year include the removal and replacement of with the introduction of a new CBN governor, which was supposed to bring more transparency and more reforms to restore investor confidence and reduce inflation. We also saw the market gain as they started doing that in January with the clearing of FX backlogs in some sectors, especially in the airline. The Nigerian equity market gained 35% in January alone of 2024, following all of these policies. However, those policies, they come with inflation, and we saw inflation start trending now, continue trending higher. The CBN's response to that was to increase interest rates significantly during that period. And we'll get to this later in the presentation, but you see how interest rates and their impact later on. So to conclude on this section, we'll go over some of the other policies, mostly just to increase FX stability and, reduce interest rates. Finally, the last major policy that I think that we saw was the recapitalization of the banks. That was a big development, and the equity market had been very positive until that moment. But we saw the announcement of this policy send stocks in that sector down 24%. So those are big things that, there's a lot of announcements. You see this, the market is always reacting, and that's something, we have to be aware of. And how do we manage our investment to cater for these market reactions? So now, as investors, especially again in frontier markets, emerging market like Nigeria, there are major concerns we have. Two of our biggest challenges with our investments are generating returns that can cater for exchange rates, volatility, which is very prevalent, and inflation, which has been expanding over the last 5 years significantly. How our objective typically is to achieve returns that can, that can surpass or survive, challenges like inflation. With inflation, everybody's trying to get what we call real returns. What are real returns? Real returns are returns that are generated above inflation. So whatever you're investing now is, if your return doesn't surpass inflation, you are losing value relative to the previous year or previous before the inflation. So those are things that investors are trying to do. When you have investment goals and objectives, and you're looking at the environment around you, you're trying to structure your portfolio in a way that can achieve returns that mitigate those risks and also surpass and achieve your objective, your investment goals. Like with the exchange rates, if you have investment goals, you want to pay school fees in dollars, you want to structure your portfolio that can do that. On the Naira front, if inflation is high, you want to maintain a certain lifestyle, you close to maintain a certain lifestyle. You also have your return to fund that in the future. And so you have to structure investment, taking these kind of things into consideration. And that's something as Nigerian investors, we're always trying to balance. And we'll tell you how we look at those challenges here, strategy for doing that later on in the presentation. So interest rates is one of the big things that happened in this recent administration. You've seen when the CBN is trying to combat this high inflation and exchange rate stability. And what is their primary mechanism for doing that? To do that, to address those concerns, is to raise interest rates much higher. The way they're doing that, the actual mechanism they're using that is through their policy rates. So we have a monetary policy rate, which is conducted by the Monetary Policy Committee, really anchored by the CBN. This is their main tool for increasing rates in the environment. And since last year, we've seen the CBN through the MPC increase rates significantly from 18% to 26%. This is a massive jump, like in 1 year's period. And that's to try to, reduce inflation and also create some stability in FX. So this is the primary policy tool they've done that through, but they also have additional policy tools. They have HOMO auctions, reserve requirements. These ones, the way they use these tools is to try to remove liquidity from the system. Liquidity is one of the biggest drivers for inflation. If there's so much money in circulation, it's going to drive up prices. So the CBN uses both reserve requirements, HOMO auctions to reduce liquidity in the system, in turn to reduce inflation. So all of this lead to higher interest rates. CBN using all these tools to reduce liquidity. There's lower liquidity in the system. There's higher interest rates are higher, and that's what we'll see in the next slide. So the first chart we have here on this slide is of the monetary policy rates, the tool I mentioned earlier on. It's gone from 18% last year, around before the previous administration came in, to 26.25. That's almost a 10% jump. A significant increase, if you ask me. Yeah, this is because inflation has been very, very high. And currently, inflation is about 3.9%. And what CPN hopes is that with this raise policy rates and following raise interest rates, this would help reduce inflation. So right now, this is the chart I have below is of interest rates in the market. So the lowest chart there, the lowest line there is of where rates were in 2020. It shows rates from 3 months to 30 years, rates on securities from 3 months to 30 years. During that period, we've seen the one on top is for where we are as of 2024 now. So we've seen rates increase significantly on both the short end and long end. On the short end, we saw rates rise from 3.6% in 2020 to about 19% currently, even as some people are getting as high as 26% in some securities. And on the long end, from 8.3 to about 18%. That's a 10% percentage point increase, a significant increase. And so this is where people are seeing these rates increase following this policy announcement, and they're thinking, okay, how does it benefit me? And a lot of people do that by now trying to park their assets in short-term rates. The risk there is what we call reinvestment risk, because there's some policy can also always change, and then you're exposing yourself to reinvestment risk that will not allow you to achieve real returns, because you're only investing for 1 year or 3 months or even less than that. You're getting this 20%. You're excited, but if the policy changes before the end of the year or by the next year, you now find yourself struggling to invest in fixed income markets. You're concerned because if you miss the potential right in the equity markets, and you're thinking, what would I do with my money? This is a situation I've seen happen play out many times. So it seems attractive where rates are right now, but it's dangerous to allocate most of the money into that asset class right now. And that's something we just wanted to capture for you. So how do we now achieve those real returns I mentioned? It's through equities. Equities is the primary mechanism. It's the most efficient mechanism to do that. And we'll explain that in the next slide. So why equities? They provide you the ability, they have uncapped upside. They have the ability to do capital appreciation. And that really means high returns. So people are coming to this year, they're expecting interest rates to be higher. They're worried about their investments. So people try to move into the equity into the fixed income market, and then they missed out on similar upside. In the January alone, I've said the market went 35%. That's a massive increase. If you invested in Dangote and some stocks specifically, if you invested in Dangote, which is one of the largest cap names in the Nigeria Stock Exchange, increased from about 300 naira to about 600 naira during that month. So that's a massive rally. It's very difficult time those rallies, but those are things you can get by investing in equities. Investment has a fundamental principle. Higher risk equals higher return. So in order to achieve these returns, you have to take risks, and that's equities have variable returns, and that's where you get these returns from. So that's the first advantage of investing in equities. The next one is that they also pay dividend income. So investors that prefer fixed income assets, they usually like those guaranteed payouts they get periodically, whether it's twice a year or once a year after their investment. So by investing in equity, you're not sacrificing that, because of if you invest in blue chip names that have a history of paying dividends, whether twice a year or once a year, you can bank on that cash flow. That cash flow is, if the cash flow is important to you, you don't lose out on it by investing in equities. You actually benefit more, because of while you're getting those cash flows, the cash flow can increase through increased dividend payments. You can also benefit from higher prices from being there long term. So dividend income is, say, secondary benefit of investing in equities. Finally, is the long-term investments. No long-term investments perform better than equities markets. Having a diversified equity portfolio is the most efficient way of achieving long-term returns. Can meet your objectives, that can tackle those challenges we spelled out earlier: exchange rates and inflation, especially for a Nigerian investor. So as I said, these are just comparisons with the other asset classes. Bonds, I think it's clear your returns are going to be lower, and you miss out on potential upside that can help you deal with challenges. Real estate is a very good investment. It's a known method for hedging your risk of inflation globally. But the challenge there, especially in Nigerian markets, is that there's no easy way to do your due diligence to find out where to purchase, how to purchase real estate, or even in terms of needing to exit. If you need a quick exit, real estate is not the easiest vehicle to get out of. There are challenges there as well. On commodities, that's the other major asset class you can use. Commodities are also very cyclical. That's one risk you face there. But additionally, another risk there is that it's very those are markets you need to study extra hard to understand. And finally, for investors in Nigeria, it's also much more complex to get. So while we like gold, we like agricultural communities, we encourage people to get there. It's a much more sophisticated market, and it's just harder to play in compared to equities. So to drive home my point, I want to show you the power of equities. The power of equities. We see investors in a very uncertain period in the US. I'm sure people were worried. America just experienced a downturn. People were worried about their equity investments. They've seen some of the biggest decline since the 1930s recession. So I'm sure that would have been the time, like, a lot of people are worried. That's the time to get out of equities. But wrong. That's the time to get into equities. Because if you see that your returns, your total returns, when you account for dividend investment between the year 2009 and currently, that's almost a five-fold return. That's 500%. When you account for dividend reinvestment into your equities, that's not something you can get from the fixed income market. US yields during that period, even if you're able to reinvest your returns, we have the S&P on the index there. We have the total return there of around 60% over that period. So while you are hedging, you're staying there hedging for safety, trying to get safe investment returns on that, you are missing out on potential massive upside that can help you generate wealth and deal with all the challenges that you're facing in your environment, And and to also drive on that point, we have the Nigerian stock market as well, the Nigerian All Share Index since 1999 to May. it's returned over 3,500% during that period. Yes, the Nigerian market is much more volatile. We are in a volatile economy. You've seen so many peaks and valleys. But as my colleague Fisai will tell you later on, the way to achieve this long-term growth is by having a diversified portfolio and staying the course, just maintaining your investment objectives, knowing that in the long term, I'm trying to generate returns like that can, help me survive the any environment I'm facing. And so that's why, it's always good to look long term. Always have an image of the long-term return on the equity market in your head. It will help you stay the course because the returns, again, they are unmatched by most other asset classes. The next slide. The next slide is about how I want to show how our market compares to other markets. So we have here the returns for the local stock exchange here. That's the Nigerian All-Share Index versus major indices. So we have the S&P 500 and the Euro Stocks 50. What we want to drive home here is that returns are not homogeneous across markets. Different factors affect different markets differently. Right now, there are things that are going on in Nigeria that are driving our equity market return, and they will not impact the US equities market or the European equities market the same. And so you see that in 2019, we had a negative return, whereas investors there were able to gain. In 2022, we had a positive return while those markets were negative. Over time, though, you see in the last 5 years, we've outperformed those markets in our local currency. That why? It's because we are taking mostly higher risk in an emerging market, in frontier market like Nigeria. So you have to be compensated even more. And so we've outperformed those markets. But the point I want to say is that even if you have equity investments in other major markets, do not look away from Nigeria because you are getting compensated with higher returns. And if you have Naira obligations, this is the place, this is where to keep your long-term investments. So here on this slide, what are we trying to capture is that how do you get long-term portfolio diversified that can help you achieve those returns, that can help you beat inflation? What do you do? One simple way, and the other ways, my colleague Fisai will take you through this later on, is through a diversified portfolio, diversified long fund and our mutual funds. We have three of our equity-based mutual funds: the ARM Aggressive Fund, the ARM Aggressive Growth Fund, the ARM Discovery Fund, and the ARM Ethical Fund. So the Aggressive Fund is our most aggressive portfolio. It can take up to 100% in equities. But as you can see, over the last 5 years, returned about 18%. The ARM Discovery Fund is it's not as aggressive. It's more of for a medium appetite portfolio investor, and it has returned slightly lower. It's what we call a balanced fund, and it's returned slightly lower over that period at 70%, which is very strong. So can help you beat inflation in most years. And we have the ARM Medical Fund. What is the ARM Medical Fund? It's also a balanced fund, but it is Sharia compliant. That means for Sharia compliant investors, don't have to worry if they're investing in names that they don't believe are Sharia compliant. So we don't have banks or brewers, any stock that doesn't comply with the principles of Sharia finance. And just to finally drive home my point, it is the power of dividend reinvesting and the power of compounding. You understand? Compounding is where you grow your assets by reinvesting your returns. As equities are assets that appreciate over time, and they also happen to pay dividends on a periodic basis. If you put you invest your dividends in something that's appreciating, you would compound your growth. This is how you grow long-term in an aggressive manner. Reinvesting your returns. Reinvesting your returns allow you to achieve the returns that we've stated earlier on. It's both in the US market and the local market. That's how you get those massive returns. Putting your investment, your dividends back into your original investments, which also are appreciating over time. So the power of compounding cannot be understated. This is the actual, with alongside the diversified portfolios, think long term. This next step of reinvesting your dividends is the thing that would help you accomplish your long-term goals and help you fight those challenges we've mentioned earlier on. So thank you for spending time with me. I hope I was able to provide some insights, and I'll hand over to Raf to continue the presentation. Thank you once again.
Wow, that was a very detailed way of sharing information, to be honest. At the beginning of the session, I'd mentioned that in 2020, I saw it in the headlines, the Nigerian Stock Exchange index returned the highest in the entire world, in excess of 50%, and you then corroborated it by then showing us, how important the advantages in the Nigerian stock market can be over other markets, the US, the UK, because again, it's a volatile economy, a lot is happening, and it's important that people should be able to tap into that opportunity. I think that's very vital. That's very key. That's a decent information to take with us from your presentation. I recall that you started, by telling us, how to go into this investment, ensuring that we have detailed information about what's going on in the macroeconomic space, understanding how the indicators will impact our investment decision, focus on setting up portfolios that will be diversified and do the necessary analysis. You mentioned, what we've experienced so far in terms of the macroeconomic indicators, the policies that have been introduced. You mentioned the removal of fuel subsidy, the deregulation of the oil and gas sector, the liberalization of the exchange rate, the appointment of the new CBN governor, clearing the FX in the airline sector, clearing legitimate FX debts as well, the contraction in the monetary policy space, the revocation of BDC licenses, the recapitalization that is expected from the commercial banks. I mean, how all of this really have either affected you positively or negatively in the capital market space, and also to help you in taking those decisions, you need to understand those impacts. I think another important part, that I picked from your presentation was that today what investors are grappling with and what they are trying to contest with really is the exchange rates and inflation, the impact they've seen in those areas. And you pointed it out that it's important, for us to go into investments that would ensure that we're making significant real return, which is returns above inflation rate. One of the important factor, that we shouldn't toy with again was the fact that you also mentioned reinvestment risk. I think that also is very, very key because today, what we understand mostly is that we just want to keep our capital fixed. We just want to take advantage. I see a lot of hands up. I think I need to reiterate again that the rules of the webinar is that if you have those questions, please send them into the Q&A box. We will take those questions at the end of the second presentation. So as these questions are coming into your minds, please do us a favor by sending them into the Q&A box. And I can assure you that we will answer them at the end of the presentation. Otherwise, we will send you a detailed Q&A in a few days, within the next 48 hours or thereabout. So please drop your questions in the Q&A as they come through in your mind. So again, I was talking about the reinvestment risk. So if you take advantage of the high yield in the fixed income space today, you never know what policies could come around tomorrow, and the yields might not be as interesting as they are today. So if you have to reinvest, then you will be investing at a lower interest rate. And again, that might not take you on that long-term journey as quickly as you want it to be. You make comparisons between the asset class, equity as an asset class, and the also other asset classes, bonds, real estate, commodities. The advantages were clearly stated in terms of liquidity in the equity space, in terms of return over the long term compared to fixed income instruments, as well as the dividends that we earn over time. I think those are also important important features to note about that asset class. I think one of the important things as well, which was an information that I picked, and I decided that I'm going to hold this information tight, with my left hand so that I don't lose it, is that since we've transitioned into the proper democracy in 1999, the Nigerian equity market has actually returned over 3,500%. And I think that's a vital information. If we are looking at long term and moving from fixed income to equity, from equity to commodities, it's not likely that you would have hit that 3,500% return. But with the equity market, stable in the equity market over that long period, you would be earning about 3,500% invested in equities. And I think the power of compounding that you mentioned is also very important. I'd always thought that you could only achieve power of compounding if you had invested in fixed income instruments. But today, you made me learn that fact that even with equities, I can benefit from the capital appreciation. And at the same time, when I receive my dividend, instead of going to have fun with it, going to the bar, instead of buying different things, that I might not need, clothes and the likes, I can actually use that dividend to buy more of those stocks and compound it, and then it takes me quicker to my destination in my long-term journey. And I think finally, you pointed out to us how ARM can assist with those mutual funds, the equity mutual funds that ARM offers today, and you showed the 5-year average return of each of those mutual funds. I think the Aggressive Growth Fund is in excess of 19%. The Discovery Fund and the Ethical Fund are also in excess of 17%. These are important information because, again, if you compare that to inflation over the past 5 years, I think those figures are quite decent in terms of giving you a real return position over the last 5 years. So I think these are significant points that you have shared with us, and we thank you very much, Alieza, for that presentation. While we make plans to get ready for the second presenter, Olufisayo Basi, we will be taking another poll just to usher everybody into the second presentation. So please, I would appeal that we look onto the face of our screen as we launch the second poll in a few seconds. All right, so if you look onto the face of your screen right now, the second poll reads, do you believe that equity investment can preserve your purchasing power over the long term? So what that means is that if you're making a sacrifice today to keep aside 1,000 Naira, and in another 10 years, you want to make withdrawal of that 1,000 Naira, you should be expecting something that you should be expecting a value that would be able to buy 2 or 3 of those things that the 1,000 Naira that you're setting aside today should be able to buy when you call for the funds. So essentially, that's what the question is asking you. So do you believe that equity investment can take you on that journey and ensure that your purchasing power is preserved? All right, we will give another 5 to 10 seconds to complete this poll, and then we will usher in our second presenter. All right, the results are out. About 91% of us on the call believe in this equity investment. 3% have said no. 13% are in between. And I think this is a task that Olufisayo Basi is coming to solve in this next presentation. Olufisayo Basi heads the investment management team in ARM Investment Managers. She's responsive. She has experienced and she has a skill set, and she's very experienced in providing bespoke investment solutions across traditional and alternative asset classes. She currently manages client base that includes institution, high net worth individuals, ultra high net worth individuals, mass affluence, and retail clients. Olufisayo Basi got a BSc in agricultural economics from the University of Ibadan and a master's degree in economics and business from Hull University in the United Kingdom. Please join me as we welcome Olufisayo Basi to take us on the second presentation for the day. Fisayo, the floor is yours.
Thank you.
Thank you very much, Raphael, and welcome to everyone once again. My colleague Alieza had spoken about equities and compared with some other assets. He also spoke about, he compared the performance of equities to, other markets. And I mean, he has been trying to convince you since to invest in equities, right? However, we're in an interest rate environment that is very high. And I'm sure you're wondering, how can I navigate this environment, irrespective of, whether I'm investing in equity? So how can I navigate? I'm investing in equities. Well, that's what we're trying to say. How can I navigate this environment and invest in equities? But before we go into that, I'm showing a chart right now. So if you look at the first chart, there are three parameters that are peculiar to Nigeria. The first one is the equity index. The second one is the inflation index. And the third one is a bond index, which represents a fixed income index. And you can see that the performance of equities actually, was quite more than the others over a period of 2019 and year-to-date 2024. And for better context, if you look at the chart below, you will see that if you had invested ₦1 million in 2019 in equities, you would have that value reduced to 908,000 the first year. However, what we are saying is not that equities is not risky. Equities remain risky if you invest in it. However, it has the potential to give you superior return. So if you look at year-to-date 2024, that ₦1 million would have given you 4.34 million naira. Look at the bond index that represents fixed income investment. The first year, it would have given you 1.3, I mean, good investment. But look at the return down the line. It's just 1.78 million if you're looking at it, compared to equities that is 4.3. Now, if you look at the rate at which inflation itself has grown in the same period, then you will see that it had grown to 2.9 million. So what we are saying is inflation equities has the power to outperform inflation and will definitely deliver higher returns compared with a fixed income instrument. So now moving on to our next slide, we'll be talking about how to navigate the high interest rate environment if we are investing in equities. So different equities react differently to high interest rates. So there are some companies where they have high borrowing. For those companies, their borrowings are, if their borrowings are, benchmarked against MPR, for example, and MPR keeps increasing. Why? Because they need to reduce inflation rate. That means those companies are also having to pay back high borrowing costs, and that will reduce their bottom line. That's their net income. And imagine the value of the companies. I mean, they will be priced lower compared with a company that is more resilient, has lower borrowing, and is able to better weather the storm. So what we are saying is look for companies that have lower borrowings, especially when interest rate environment is very high, because they're able to weather the storm compared with the ones that have high borrowing. Additionally, we'll be talking more about some different sectors in the equities markets and the ones that can perform better relative to the ones that will be negatively impacted on the next slide. So I'm going to start by speaking about the consumer staples sector. So think about it. Irrespective of high costs, when you go to the supermarket to buy things from the shelf, you still need to use toothpaste, you need to use soap, you need to use salt to cook, and some people you need to consume sugar. So companies that make these products will still need to sell. And what it means is that even if costs are high, they would be able to pass on this cost to consumers because people need to buy these things in their daily living. So what it means is these companies tend to perform well when interest rate environment is high. Some customers also already developed brand loyalty where irrespective, I must buy this brand. It doesn't matter what price it sells on the shelf. So such brand loyalties and very strong brands also are able to weather the storm. The next sector are is the utility sector. So also imagine that you have to consider alternative means of powering maybe your homes or businesses. And you are considering using diesel or maybe a petrol generator, compared with relying on electricity from your distribution company. You see that the gap is actually very wide. So what we are saying is even if you are moved to band A or a band that makes you pay more, it's still cheaper. So these companies are able to also increase the cost of the services they render, while the other alternatives are not still favorable. And you don't even have lots of competitors anyway. You may say that, oh, I can consider installing solar. The cost of installing solar is high. So except you can also take care of that cost, then it becomes cheaper to actually rely on such utilities. So it's not only electricity, there are some other utilities as well, waste disposal and things like that. So if it increases, how would you dispose of your waste? You have to pay for all these services. So these companies are able to also charge more, and so you can imagine paying more for all the service and you are not benefiting the other way. So what we are saying is invest in this company so that when you are paying more, you're also, being part of the owners of the company, and you are getting value because they are collecting more revenue from people. So pay more and also earn more by investing in these companies. The third category are the companies in the financial services sector. So imagine a bank that gives out loans, and the loans are benchmarked against MPR. So what it means is the higher rates they are charging is beneficial to them because they have higher revenue, and they have they have higher interest income rather, and they have higher net income. Also, when they buy financial instruments, maybe fixed income instruments and all that, they also make more returns from there in terms of interest income. So investing in such companies also gives you opportunity to benefit when interest rates environment is high. Now, this category of companies in these three sectors I discussed fall under defensive stocks. We have the cyclical stocks. These are the ones that tend to, move with the economy. So if the economy is expanding, there are, outputs, production, manufacturing activities going on, the economy is booming. These stocks tend to do well as well because they are, at the heart of driving the economy. So these are consumer discretionary stocks, these are industrial stocks, these are stocks in the materials and energy sector. However, when interest rate environment is high, some of them have high borrowings, and they are not necessarily able to transfer higher cost into their products, and they get beat, and you see the price of these stocks decline on the exchange. But for the defensive stocks, they're able to weather this. I told you earlier, I had mentioned the utilities, consumer staples, healthcare. I mean, we all have to access healthcare, irrespective of what is happening in the environment, right? So, in the economic environment, telecoms as well is very key. So, these are stocks that are able to weather the storm when the economy is facing challenges, interest rates are high, and companies are actually finding it a bit difficult to run their businesses because rates are really high. They can't borrow to expand. So, these are resilient stocks. Now, I'll be moving on to the next slide by discussing apologies, by discussing the strategies for long-term success. So we have said invest in equities, consider these stocks rather than these. But what are the strategies you can actually use, to be successful while investing in equities over the long term? So we have two strategies that we're going to discuss with you today. The first one is diversification, and the second is staying the course. What do we mean by diversification? I met a client not long ago, and she said, during the 2007, 2008, she had spoken with someone, and the person said, you know what, buy Transcorp and all that. So she invested about 100 million naira in Transcorp. And at the end of the crisis and all that, she was only able to get 10 million naira out of there. And she said, never, like, there's nothing you guys can say. I can never invest in equities. And I know that a number of us are in that category. But imagine what my colleague said. From that period onwards, equities had returned superior, recovered, some of the loss and everything that had been incurred over them. And remember, if she had diversified her investment, even if the entire market is down, there are some stocks that would, feel the impact more than the other. So what we are saying is invest across board such that you are not exposed to that risk. Diversification is not saying that make the most of, the highest returns you can make, because having that exposure also means having exposure to the highest loss possible. What we are saying about diversification is invest across board such that even if there's a risk, you are protected. That protection is So important. So you are not 100% covered, but there is some form of cushion because you have invested across board. So while some equities are reacting this way, the others are not. So the correlation between the assets in your portfolio is not positive 100%, so that once there is a movement upwards, you enjoy it. And when the movement is the other way, you also lose so much. So the benefit of investing is to diversify so that you can reduce the risk that your portfolio will be exposed to. So if you're investing in equities, it is extremely important that your portfolio is diversified. The second is staying the course. Staying the course is, it's not buying stocks today and then you say, oh, market is a bit bearish, people are selling off, you sell. And then tomorrow, oh, it's up again, you buy. Why? Because in the process of doing that, someone that stayed and remained there remains invested. So, and look at the chart over a long period of time. I mean, we have to bring that in to show you how it really works. You see that volatility because it's equities. However, in the long term, you benefit. So staying the course is remaining invested. So remember what we said, equities will give you superior returns. In order to invest in equities, consider stocks that have very good fundamentals, the ones that will not have undue exposure to risk, and invest not only in one stock, invest across board. And when you invest across board, also have the patience to wait and see your investments actually generate enough returns. I'll tell you another story. Last year, we bought some banking stocks and, markets was selling off. And then for some of those stocks, we exited. Well, what happened? It rebounded. And so the performance of the portfolio we did that on compared to others was lower. Why? Because those ones remained invested in banking stocks and, they enjoyed the benefits while the one we exited actually returned less than. So if you're timing, you can't adequately time markets. So if you're planning to time markets every time, it may not work because you don't have 100% of information that will enable you to sell and buy immediately. Even when you say, oh, you know what, I've made enough gains, I need to quickly exit, and then you're trying to sell, nobody to buy, all those things. So invest and stay the course, and over the long period of time, enjoy the benefits of equities investments. Now, moving on, we've said we've added strategies and all that. Now, we are not living without recommendations. How do I even, enjoy these benefits? How do I take part in equities investment? ARM investment managers offer 4 distinct services. I'll first be speaking about 2 of them. The first is the portfolio management service. The second is mutual funds. So for the portfolio management service, if you have up to 100 million naira, we can set up a dedicated portfolio that is customized to your needs. So what we do is to profile you and determine your risk appetite and, your ability to take risk. And when we do that, we'll consider this in the asset allocation. That's the asset that will be in the portfolio. You would enjoy some other services as well, reporting, portfolio monitoring. We can help plan your liquidity management. So, I always need this amount at so period of time. I always need periodic income on this portfolio. All those things will be put in there. So it's largely what you want that will be in that portfolio. However, if you don't have up to 100 million naira, you can still enjoy the power of investing in equities through our equities mutual funds. So we have 3 different mutual funds that have equity exposure in them. There is the aggressive growth fund. So that has between 70 and 100% equities. So if you're trying to gain exposure, you can buy that stock. We have the discovery balanced fund. That fund, for instance, has up to 29 different fixed income investments and about 21 equities in it. And with as little as 10,000 naira, you are buying bonds, different bonds. You have corporate, sovereign bonds. You are buying commercial papers. You are buying treasury bills, and you are buying different stocks. So, that's very powerful. And the portfolio is well diversified. It's professionally managed by the portfolio managers, and it is liquid. So that's a very fantastic option for someone considering investing in mutual funds. We also have our ethical fund, which also has exposure to equities. So it is the one that is Sharia compliant. So if you want to invest and be Sharia compliant and still want to enjoy investing in equities, equities, then the ethical fund is for you because it helps you. So it is balanced. It has about 50% exposure to equities, 50% exposure to fixed income. So you tend to benefit from that as well. So I'll speak about the financial planning service and the financial advisory service next. For the financial planning service, I would also tell another story. So in my second year of managing portfolios, I was privileged to manage a portfolio set up by a man. By the time I was managing, the man was late. However, he gave instructions to the investment management company to always pay his son's school fees every September. So what happens is, in managing the portfolio, I'll make sure that there's an investment that will mature before September 1st so that that school fees will be available. So the portfolio took care of the son from when he was in primary school till he graduated. When he was going into the university, he actually gained admission to a private university. He got laptop, we paid the school fees, and I looked at the portfolio. It will take care of him till, when he finishes. And then additionally, the man gave instruction that his wife should be able to access the portfolio to get loans to buy goods for her shop every year, once every year, and she will return it so that at least it's sustainable. So she will sell and then return without interest, free loan for her. So without interest, she will get the loan, buy things for her shop, sell at the end of the year, and then return gradually the following year. And this portfolio took care of the wife and the son just through the entire period. The man also said, once my son graduates, give him this particular amount of money for him to set up. And all those things were done, So that is the power of financial planning. Financial planning goes beyond just setting up a portfolio. Oh, I want aggressive objective, I want income and all that. No, it's achieved something unique to you that is special. Maybe it's retirement planning. I'm planning retirement, but I'm not sure my RSA will be enough. I mean, how much have I saved so far? How many years to retirement? I need a proper retirement planning service to be in place. Then, you set up a portfolio to achieve that purpose. Or, oh, mine is estate planning. I'm trying to hand over my assets. I have lots of assets. I'm trying to hand over to my next generation, my kids or beneficiaries. So financial planning actually, covers a lot more. It takes care of, so many things: risk management, debt management, and whatever it is you're trying to achieve. So it is more tailored to achieving something very important to you. So that's the power of financial planning. So we get information across, but everything that would impact on that portfolio, we get information on it, and we put together a portfolio that will address the needs that are most important to you. So the financial advisory service we offer is, that service where you engage us and we discuss investment that are suitable to you based on your goals, based on your risk profile, your objectives and all that. So it's an advisory service where, we discuss in detail all these things, get information and advice on what is suitable for you as an investor. And ARM investment managers offer these services. Okay, so once we have determined your risk profile and objectives, there are three ways in which you can, there are three, so we could categorize you into three different objectives. There are more, but we are just bringing out three for the purpose of this presentation. The first is, if you have the tendency of, having a lot of exposure to equities, whether because you have more time, you can actually waste the time and enjoy the benefits, or you have lots of funds, so your finances, your investment will not be largely impacted if you put what you have, more of what you have now, in equities. Then an aggressive portfolio may be suitable for you. So what we do is we set up a portfolio and it has more exposure to equities. The equities stocks, the stocks can be either in Naira, USD, or whichever currency, as long as you have access in that market. And as CRM investment managers, we do have access to a number of markets. So we help you to actually gain exposure to those stocks. And if your profile is aggressive, but you don't have as much as 100 million, you can invest through our mutual funds. Remember, I mentioned the aggressive growth fund. So you can invest in that fund. The fund invests up to 100% in equity, so between 70 and 100%, while the remaining 30% is to take care of people that want to exit and just to balance things up at times. So that fund is very suitable for you, and you can invest with as little as 50,000 naira. Then the next objective is moderate or balanced objective. So here we can set up a portfolio for you as well, where maybe you do not want too much exposure to equities, but you still want to enjoy the benefit of investing in equities. Perhaps you have some goals that nearby and you don't have that long time to wait, to invest in all your funds in equities. So we balance things up by gaining exposure to some equities and some to fixed income instruments. So by that, you have like a moderate or balanced portfolio. If you don't have up to 100 million for us to set up a unique portfolio for you, you can also invest through a mutual fund. So we have two mutual funds in this category. The first one is the Discovery Balanced Fund, and the second is the ARM Ethical Fund. Those two funds are one of the top performing funds. Even the Aggressive Fund, they are the top performing funds in Nigeria as of today. And I'll tell you another story. So a client invested 5 million naira in our Discovery Balance Fund about 20 years ago. The client bought it at 100 naira, and sometime this year, the client reached out to his relationship manager and said, is there a mistake in my portfolio? I invested just 5 million naira, and I'm seeing 35. What happened? So I looked at it and said, I mean, the price of the fund had grown from 100 to 700 and something. So just multiply by 7. So it's real. So we are saying that, and that's the one that invested in Discovery Balance Fund, not even the one that is more aggressive, So if you gain exposure to equities, it can give you superior return in the long term, as long as you are willing to wait and invest in it. And for our clients that are ethically inclined as well, they can consider investing in our ethical fund because that's suitable for them. And the last category is conservative portfolios. So here, you want some exposure to equities, but very minimal exposure to equities. Maybe because you're nearing your retirement or your objective is really nearby and you don't have that much length of time to wait to invest in equities, then we construct a portfolio for you where you have just, minimal exposure to equities, maybe as high as 25% or even less than that, depending on, what you want. And you still enjoy equities investment, but you have more of your other investments in fixed income to give you periodic returns, periodic but fixed return, So that is more short-term in nature compared to the equities portfolios and mutual funds. Then we have the conservative mutual funds. So these are mutual funds that have more fixed income investments in them. We have a money market fund, we have a fixed income fund, we have a Eurobond fund in dollars, and and we have some other private products as well that fit this category. So moving on from there, so we are going to discuss why you should choose our portfolio management service. We have been in the market as ARM Investment Managers, has been in the market for more than 30 years. And we have developed expertise in selecting the best portfolio, in working with clients, in managing risks. And these are very important when you want to set up a portfolio, especially the one that has equities. Also, in terms of time management, the time it takes you to start researching a company, trying to know, oh, is this investment suitable for me and all that. It is good that you learn or know about all these companies, but to reduce the time, we have services that can help you research, conversations, advisory service that helps you to reduce the time it takes to make all these decisions so that you can also start on time. I'm sure there are some people that wonder, should I start, should I not start? And then before you know, it's a year, 2 years, 3 years is going by. But we help you, we give you the information you need. You're able to, discuss and review and make informed decision from there. And the third one is active risk management. Risk management is at the heart of what we do. So we are not saying that we want you to make like the most return. What we are saying is we want you to make superior returns while your risk is managed so that you are not unduly exposed to risk that would hamper you getting your investment objectives. And diversification is extremely key when you are investing in equities. It's always good to diversify so that you are not also, it's all risk management strategies so that your risk management your risk exposure is minimized while you have the tendency to enjoy the benefits of the assets you are investing in. So I'm moving on to the next slide where I'm going to talk about I'm going to wrap up more or less. So what I'm talking about is why you should take the bulls by the horn. Why? because the companies right now that are struggling, we all know interest rates is high, rates on loans are high, it's difficult to borrow even from the markets. People are demanding for high rates and all that. The economy may slow down because of that, because whenever rates are high, then people are unable to borrow to fund, their expansionary activities, and what you see is reduced production and all that. Apologies. So because of this, I mean, there are potentials as well. So what we are saying is look out for equities you can gain exposure to now. Another thing we are even saying is, do you know, so there was a study where they said even if you had bought equities in a particular year at the highest price possible, that over a long time period, you will still make superior returns, even if you had bought at a very high price. So you can try to time the market and everything, but see, the benefit is just invest in equities and wait out. As long as the equities you're investing in or the company you're investing in has very good growth potential and is paying dividends. So if they have very good growth potential, they continue to grow and expand and everything, then your investment will also, because to reflect in the value of the investment, you also benefit from it. So what we are saying is invest in equities. Cost of borrowing are very high right now. You may be considering fixed income investment, but when it matures, and it has matured, you may not get the same rate again after your treasury bills has matured. So, but to invest in equities, be willing to wait the long term, and you would enjoy the benefits of doing that. So, consider companies that have strong balance sheets, that have robust business models, and you would definitely enjoy that, and you'll be able to weather the high interest rate environments that we are right now by investing in equities. And to conclude, equities remains a very powerful investment tool to achieve long-term wealth generation. And to invest in equities, you need to diversify your portfolio and tailor it to your financial goals and objectives, and you would achieve successful investments. Thank you very much for listening. I will hand over to Raphael now to take the question and answers. Thank you.
Olufisayo Basi. Is she not? Actually, I think she has proved that she's an evidence for supporting a girl child's education, isn't it? I think she's a proof that everybody needs to support a girl child education. And she also needs to tell us if she's currently writing a book on equities, so that we can patronize her and buy this book. Thank you very much, Olufisayo Basi, for the insightful presentation and all the tips and vital information that you have provided. I think it's important for us to note that she has actually answered that poll at the beginning of our presentation, where we had some people that were in between, should they believe that equities can serve as, can preserve their purchasing power over the long term or not. I think she has provided that answer as well, saying that, a perfect investment, if you're looking for returns above inflation rate, real returns above inflation rate over the long term, then equity is your best asset class. It's the most recommended asset class. You've talked about the impact of the high interest rates on the economy, how to carefully select the sort of companies that will benefit from that kind of environment, and even whether there is rainfall that is beating all of us and we're getting wet, or there is sunshine that is even turning our skin to black, we should stick with, these sort of stocks or these sectors that you have explained. So in those sectors, you spoke about consumer staples, you spoke about utilities, you spoke about financial sectors, how they could be resilient, to whatever is happening in the economy. You went further to classify, how we can also make these decisions into two different groups as well. You said cyclical stocks and defensive stocks, and the defensive stocks are the ones that, whether it's rainfall or it's sunshine, they would always stand the time. Cyclical stocks move with the economy. So if things are doing well, they'll be doing well. If things aren't doing well, then they won't do well as well. But in terms of defensive stocks, they're always there, whether things are going on well in the economy or not. And these are the sort of stocks that you have said that we need to pay attention to. You also mentioned to us two key strategies that we should focus on: diversification and staying the course. Diversification is that we shouldn't put all our eggs in one basket. We should invest in stocks in different sectors, just to ensure that if a particular stock isn't doing well, others are able to cushion up for that loss. And then staying the course is that we should be disciplined and stay focused on the long term. Long term, long term, and long term was the emphasis you also made. You went ahead to tell us, just the same way the first presenter concluded his presentation, you went ahead to tell us what ARM can do to support us. You mentioned the portfolio management services, which again, you spoke about the advantages at the end, which is time management. It enables us to focus on other things while you use your expertise to manage our time to take investment decisions on our behalf. Active risk management, you're always looking out for us in terms of balancing the risk and the return. And then most importantly, it's always diversified. So again, you're taking your own time to do your job, which is your 24 hours role, while we are able to then focus on our own jobs and continue to make more money that we can, do nothing else but bring them to you so that you can continue to help us manage and grow them. Part of the ways by which you mentioned that ARM could also support us is via mutual funds. This is also a diversified portfolio, sort of, but it's very, very interesting for small savers to tap into the opportunity of investing in equities today. I think there are about there are about three types of equity-related mutual funds that ARM manages today, and these are stocks that they are currently doing well in the market. These are mutual funds, are products that are currently doing well in the marketplace that we can all leverage on and tap into the opportunity that the equity market offers using your expertise. You spoke about financial planning as well, which is a philosophy that helps people build wealth, across all the stages in the financial life cycle. That is also something that ARM provides today. So from the different stages in the financial life cycle, ARM is able to guide you and able to support you to be able to achieve each of the goals, as you move up the financial life cycle ladder. You also spoke about financial advisory, how you help people to put together their goals, have a listen to them, and then you're able to help them put together objectively their goals and also support them, on how to begin to grow their finances to achieve these goals, one after the other. And I think finally, you spoke to us about how to align your risk profile with your financial objectives. I think that was also very, very interesting and very important as well, vital to every one of us on the call. So if you're aggressive, if you have an aggressive risk profile, you need to align, your portfolio. You need to align your risk profile to your portfolio. So you also need to align that with an aggressive portfolio or a mutual fund. If you have a moderate risk profile, you need to align that with a moderate portfolio or a moderate, mutual fund. And if you have a conservative portfolio, then you need to align that with a conservative mutual fund. If you have a conservative risk profile, you need to align that with a conservative portfolio or a conservative mutual fund. Aggressive in the sense that, you can watch your investment go up and down, and you're probably still young, and you have a lot more time ahead of you. Then you can align whatever you want to achieve with an aggressive portfolio and aggressive mutual fund. If it's moderate, you're in between conservative and aggressive, then you have to align with a moderate portfolio, a conservative or a moderate mutual fund. But if you're conservative, you don't want to hear any story. You just want your funds, safety. You want your fund safety. You don't want to experience any form of volatility. Again, we've heard about the impact of such portfolios, especially if it's fixed income related. We've heard about the impact from the first presenter. So again, we need to be mindful of that, if we have a conservative portfolio. But however, if you are retired already, then maybe that would be suitable for you, because you need to preserve your portfolio to a large extent. I think these are the tips that Olufisayo Basi has provided for us from this second presentation. And these are very, very important, in managing our finances and managing our portfolios. They're not things that we should receive today and then we dump them, immediately after this session. I think there are things that we need to put to use to ensure that, we maximize the benefit of this session that we've spent some time sitting in today. We have about 15 more minutes to go. We will take some questions now, and then we will wrap up. But like I said to you earlier, keep posting those questions into the Q&A box. We will begin to respond to those questions now. If we're unable to take all the questions because we're pressed for time, we will share with you a detailed Q&A in response to all the questions that we have seen today within the next 48 hours or so. So please bear with us. We're pressed for time, and we know that you would also want to quickly get back to work. So in the next 14 minutes or thereabout, we will be closing out on this webinar. But for now, we're open to taking questions. Drop them in the Q&A box, and we will try as much as possible to cover as many questions as possible. The first question that I have here is for Olufisayo. Someone is asking if we can set up a multi-portfolio with ARM. Olufisayo.
Yes, you can. So remember I said that we would always determine your risk profile. So you just start a set of questions where that would enable us to determine your risk profile. So knowing your risk profile and your investment objective will enable us to tailor your portfolio to your needs. However, you can also gain exposure to, some other mutual funds and have other portfolios with ARM. For example, you can have your investments in Naira, you can have another in USD. It's also a means of diversifying your investment. So yes, definitely you can gain exposure to multiple assets through ARM.
Okay, thank you very much, Olufisayo. The second question, I think this can be taken by Alieza. Currently, I think it was one of the things you had mentioned actually in your first presentation. By the way, the theme of this presentation is Equities, the superior long-term investment. If you're just joining us, you're actually at the right place. That's the theme of the webinar, and that's the right webinar that you're sitting in right now. So Alieza, the question is that looking at the current fixed income space, yields are high. Why can't I invest in this fixed income space right now? And then if yields decline, then I can switch to equities. Yeah, so that's the question. Alieza, are you there?
Thank you, yeah, thank you, Rafael. I'm here. Thanks for the question as well. So with regards to, trying to manage, trying to optimize your portfolio, you see high yields, you place it there, and then when you think equities are high, you try and chase that momentum there. It's a very risky strategy. I think one of the first points I pointed out was that the first risk you face is reinvestment risk, because you don't know what returns and where interest rates will be once that investment matures. And even if it's less than a year, it's not up to a year, and so you not get that yield that you even thought you would get. So if you invest for like 6 months at 18%, you only get 9%. Whoever yields are at the end of the second half of the year, it might be much lower. And at the end of the day, you see that you'd have gotten maybe less than that 18% for the year. We think there's a place for fixed income in your portfolio. It's all about allocation, allocating the percentage that needs to be allocated to equities. You can speak with any of our, if you're a client, you can speak with any of our team members. We will to tell you how to structure your portfolio to make sure you have the right allocation for your needs, to equities, and stay in the market long term. So when you stay in the market long term, there'll be peaks and troughs. Besides the stress, there's no optimal timing for the market. Even if you bought it the most expensive time of the year, on the long term, if you're looking 5-10 years, you would still probably outperform other asset classes, including fixed income. So we urge you not to stress yourself trying to time the market. Obviously, if your fixed income portion of your portfolio is doing well now with where yields are, appreciate that, but that should not make you shy away from getting to equities, because that's really where you get the biggest bang for your buck. And that's the place where you can actually grow your wealth. And being away from the equity markets is just limiting your opportunities, limiting your upside. So I would strongly advise you to watch your allocation and do not shy away from the market. You cannot time the opportunities. Thank you.
Thank you very much, Aleza. You heard it from the experts, not me. Long term, long term, long term is the game you have to play with equities. Don't time the market. And if it's long term that is the goal, then you won't benefit as much as you would if you had stayed disciplined and focused on long term when you start playing games with fixed income today and then equities tomorrow. So get into equities and stick there for the long term. There's a question here. Is there any of these products that pay dividend monthly?
So in terms of equities, right? The equities don't pay dividends monthly. Even fixed income don't pay dividends monthly. You want these companies that are investing in to be able to generate profits, right? So, and they need that capital, and you're not able to do that if they invest on they pay dividends monthly. So most companies pay either once a year or twice a year. So there are companies that pay interim dividends. We have a lot of tier one banks, they pay dividends twice a year. So GTB, Zenith, the likes, they pay an Access Bank, they pay dividends twice a year. So that's one way to do it. And unfortunately, in Nigeria, we don't have a very deep market where you can structure, where there are different companies with different year ends, can allow you to structure a portfolio to get dividends for each company's year end. They are mostly 3 or 4 year ends. So unfortunately, that's not possible, but I think twice a year, that is a very strong, that can visit even fixed income bonds, which do that. So I think that's a very strong way to do to go about it. Focus on those companies. If you're a cash flow interested investors, focus on those companies that pay dividend twice a year.
What about your mutual funds? Do they pay dividend?
Our mutual funds,
Okay.
our equity-based mutual funds, our goal is to pay dividends at least once a year. And that our goal is to pay dividend once a year on both our equity and fixed income mutual funds. And we think that's also a great way to give returns to investors. You also have the opportunity, as I said, I like to stress compounding again. You also have the opportunity to reinvest that return back into the mutual fund and grow that portfolio even more. So I would stress that we want to be able to focus on investing, not just paying out monthly. So I would urge you to, if you're a cash flow focused investor, just focus on the one dividend payment you get a year and try and reinvest that. That is what will allow you to achieve that compounded that you are seeking.
Thank you very much, Aleza. The other question here is, will you share the presentation material with participants after the meeting? Oh, yes, we will. And that will come with a Q&A that we will also be sharing in the next days. The third question here, or the other question here, trying to get at it. Is it possible to transfer my shares with a broker who has been incommunicado for some years now to ARM? Yes, this is very possible. At the end of the presentation, you will see our contact details, which is wealthadvisor@arm.com.ng. Please send us an email and we'll take it up from there. Can you set a daily profit take limit for my aggressive fund? Aleza Fisayo, this question is for you.
Okay, so for the aggressive growth fund, the fund allocation is actually determined by ARM investment managers. So you don't have control over what is bought and what is sold. So if you're invested in it, you're invested in it. If you want to track the performance, we have the opportunity for you to track. You can check the performance on different platforms. There's the FMAN platform. You also published in national dailies. You can track the performance. You can also check our website for the performance of the funds. However, to determine what level of returns you get, you don't have control over that because they are mutual funds. So we determine that based on an asset allocation that has been approved by SEC and actually falls under SEC's category of, equity mutual funds. So all equity mutual funds have that same allocation. So what differentiates us from others is now how we're able to take advantage of, the equities market and invest in different stocks that will generate superior returns for our investors. So you may not be able to control or have influence over whatever returns or set uh, daily profits limits on it. And remember when we also said that if you're trying to time market, buy, buy and sell, you may not actually know when you have sold and you are missing out on some opportunities. So, for example, maybe some of our clients that probably sold their aggressive growth fund last year, they may have missed out on the 19% or thereabouts that we achieved just in January alone. So, invest in the long term. It is extremely important for any equity investment or mutual fund. Thank you.
Long term, long term, long term. There's a question here. We've been saying long term, but we didn't define it. So the question here is long term is hazy. What is the minimum time frame to expect favorable returns in equities investments? Long term is hazy.
Okay, so some people consider 7 to 10 years as long term. Some say 20 years. So how long is the long term you are willing to give for your investments to, enjoy the superior return as long as possible? If you can leave it for 20, 30 years, fine. If it's 10 years, then, you also reevaluate your investment in that period. What we are saying is as long as possible. If it's something like 5 years, that may not be long enough. It may not be long enough. However, you could have also had some upsides in that period. But if you wait long enough, you see the cycle of, when equities actually perform so well, and then when there's a trough, there are actually some things there are some factors in the environment, in the macroeconomic environment and financial market that influence those. So for those cycles to, occur and then to be relaxed and all, you would see different varying performances of equities within that period. So you want to be there for as many cycles as possible so that you can enjoy the peak and then when the trough comes as well, you are still in the market and you can actually even gain more exposure at that period if you want. So long term is staying as long as possible so you can enjoy it as many cycles as possible that will give you as many peaks as possible. So that is our definition of long term. Thank you.
Does ARM have a stockbroker? Yes, ARM has a stockbroker. Please, does ARM invest in foreign equities like Apple's, Amazon? This is where my investment interest lies at the moment. Guys, question is yours.
I'll take that question. We have a private product. It is called GCMEQ. So that product enables you to gain exposure to foreign stocks. However, remember we stressed risk management. If you buy Apple, Amazon, and all that, our price, because of the price and the volume you have to buy and all that, we decided to go the route of investing in ETFs. Because if you buy Apple, for example, and you put all your investments in Apple, you wouldn't have achieved a diversification of your portfolio. And if anything happens to Apple stocks tomorrow, then you tend to feel the impact as well. So that particular product is a private product. We gain exposure to these stocks through exchange traded funds. So the ETFs are in US dollars and they have all these stocks in them. So as long as ETFs, for example, S&P 500, if S&P 500 is doing well, then and we have it in that portfolio, in that product, then you also benefit because you have invested in it. And S&P 500 actually has, the top 500 companies. So, and that's just one product. We have some other ETFs as well. So we manage that product with a very strong risk management practice by investing through ETFs. It is in US dollars, and those ETFs have, these stocks in them. And one way or the other, you have gained exposure to them. So you can reach out to us to take advantage of that by investing in the product.
Yeah. So in response to your question, we have a product that can that you can use as a platform to access those specific stocks that you have itemized. Let's say one is contemplating investment for a 5-year period. Which fund would be advisable between MMF and aggressive growth fund without emphasizing on the risk appetite concept?
Okay, so for this, if you want to use MMF and aggressive growth fund, it depends on your objective. So you can actually have some exposure to MMF and some to aggressive growth fund, or you can invest in a discovery balanced fund. Remember, I said it is a balanced fund. So if for example, equities will not perform so well in the next 2-3 years, the fixed income aspect of the portfolio will be doing well, at least in that short term. Why? Because your horizon is already fixed at 5 years. You're not investing for 10 or 20 years. So consider a portfolio that has more steady investment. Why? Because you do not have that, or you don't want to stay longer than 5 years. Why? Because of whatever plan you have. So consider a portfolio that would cushion that impact while you still have some exposure to equities. And if equity peaks within that 5-year period, you get to enjoy from it as well. So consider a balance, or it depends on you as well. If you do not want too much exposure to risk, then you can have some exposure to equity. So you can have exposure to AGF, maybe 30%, and 70 to MMF if you want. Or if you want it 50-50, then you can have exposure to Discovery Balanced Fund. So it depends on you and what you're trying to achieve. And because the horizon is fixed, then consider actually, combining both of them, but not just probably aggressive fund alone because of the 5-year limit period. Thank you.
All right, thank you very much. It's 11:32 by the time here. We had slated this for just an hour and a half because we know that a couple of you on the call will have to get back to the means by which you make money, which again, ARM is expecting that you would bring to them for them to help you manage. So I think it's about that time that we released everyone to get back to work and begin to make that money. But before we do, our executive director is here to give a closing remarks. Once again, we thank you all for spending this moment with us. We look forward to seeing you again in the third quarter. However, like I said earlier, keep bringing in those questions because our intention is to ensure that we respond to all the questions that you've posted in the Q&A box and share the document with you, as well as our presentation slide and probably the recording of this webinar within the next couple of days. Executive Director is here. He can't wait any minute. He really wants to say thank you to everybody for being on the call. His name is Munir Boba. He joined the RM in November 2022. He has a robust experience across all asset classes. So we call that a multi-asset class skill set, and that is what he possesses today. He's worked in Paris, he's worked in London, and now he's working in Africa to provide us with that experience, support us with that experience that he has. Munir Boba, the floor is yours.
Very much, Raphael. And thank you, everybody, for attending this session. And we appreciate those who stayed till the end. Your time is valued. We hope you found the session engaging. Our presenters shed light on essential aspects of long-term investing, especially as the topic mentioned it, with regards to equities. In recent years, like they said, amidst policy shifts, inflation, and exchange rate fluctuations, sessions like these have become crucial. As asset managers, our focus remains steadfast on providing informed guidance during those very challenging times. Our primary goal is to identify opportunities and manage risk effectively across diverse market conditions in order to achieve your investment objectives. At ARM Investment Managers, like Olufisayo Bassey mentioned, we offer a comprehensive range of products and services like mutual funds, portfolio management services, financial advisory, and financial planning. Those products and services are designed to help you navigate any investment environment effectively, ensuring that we meet your financial goals and expectations. Once again, thank you very much for your participation and trust. We look forward